Welcome to G2 Weekly Market Update, where we break down the key global market moves, central bank decisions, and economic signals shaping investor sentiment. It was a week defined by mixed equity performance, easing inflation pressures, and a major shift in global monetary policy led by Japan. United States. US equity markets ended the final full trading week of the year mixed. Small cap stocks underperformed while the Dow Jones Industrial Average also finished lower. The S&P 500 and mid-cap indexes were largely unchanged and the Nasdaq Composite edged higher, supported late in the week by cooler inflation data and encouraging earnings from semiconductor maker Micron Technology, which helped stabilize sentiment around artificial intelligence linked stocks. Earlier in the week, markets were pressured by concerns over elevated technology valuations and uncertainty around AI capital spending. Sentiment improved after US inflation data surprised to the downside, with consumer price growth slowing to the weakest pace since early 2021 and shelter costs continuing to ease. Labor market data remained mixed, showing a rebound in payroll growth alongside a rise in unemployment to a 4-year high, signaling gradual cooling rather than sharp deterioration. In fixed income, US Treasuries posted gains as yields declined following the Federal Reserve's recent rate cut, while high yield credit sentiment improved later in the week. Europe. European equities advanced, supported by steady growth signals and a gradually easing monetary environment. The Stocks Europe 600 closed higher with gains across major markets. The European Central Bank held interest rates steady, reaffirming a data dependent approach while upgrading its medium term growth outlook. In the UK, the Bank of England cut rates by 25 basis points as inflation slowed and labor market conditions softened further. Sweden and Norway kept rates unchanged, reflecting a cautious stance amid lingering inflation risks. Japan. Japanese equities declined as technology stocks weakened when tighter monetary conditions weighed on sentiment. The Bank of Japan delivered a widely expected 25 basis point rate hike, taking its benchmark rate to 0.75%, the highest level in 3 decades. While the move was fully priced in, investors focused on limited guidance regarding future hikes. Government bond yields rose to multi year highs and the yen weakened modestly, even as inflation and export data continue to support the case for further policy normalization. China. Chinese markets were mixed as fresh data highlighted continued weakness in domestic demand. Retail sales growth slowed to its weakest pace since pandemic, while fixed asset investment and industrial output missed expectations, reinforcing concerns about the sustainability of the recovery. Authorities reiterated a measured policy approach favoring liquidity support and structural adjustments over aggressive stimulus, signaling continued reliance on a manufacturing led growth strategy. G2 takeaway. This week highlighted an increasingly divergent global policy landscape. The US is moving into a phase of slowing inflation and a cooling labor market, reinforcing expectations for a more accommodative Federal Reserve. Europe is cautiously easing policy as growth stabilizes, while Japan has taken a decisive step towards monetary normalization after decades of ultra loose policy. Meanwhile, China continues to face structural challenges with domestic demand lagging despite targeted support measures. As we head into an year end, markets are likely to remain highly sensitive to inflation trends, central bank guidance, and growth data. Volatility may stay elevated as investors position for 2026 amid shifting interest rate cycles and evolving global growth dynamics. That is the G2 Weekly Market Update. Thanks for watching, and we'll see you next week with more insights from global markets.